Good evening, everyone. Time for another silver update. This is the daily chart of silver provided by netdania.com. Now, I'm going to show you the line I've drawn in here. You're probably all familiar with the proposed 1% limitation on the move, the price of gold and silver. I don't remember if it was CME, COMEX, but let's do the math real quick here. Let's do $20 silver price times 1%. We'll do 20 days for a month, so we'll start off with 1 month. So you can see after a month that yields 24.4. That's roughly where we are here. A little bit lower line, and you'll see the reason why is because it doesn't quite stay at that pace. So another month. We're at almost $30. Three months we're at $36. And 4 months puts us at $44. So that puts us right here at the top of the chart in 1, 2, 3, 4 months. So it's actually a steeper line than this. So you can see that it's not really relevant if silver goes limit up all those days in a row. It's going to reach a phenomenal price. Now, of course, you can see that it exponentially increases, so we get to the point where we're moving a lot in a day. You can see now we're talking 66 cents a day when we're up there, and then, of course, by the time we hit 100, then we're going to be talking $1 a day move. So then it just gets to the point where it's totally irrelevant, and it may slow down the price rise, but it's not really going to have an effect. Now, I wanted to go over to some stories here. We'll start off with the debt to the penny. Now, I always do a calculation on this based on the 1 year. So a year ago, we're at $16.788 trillion on the total public debt. If you remember, I covered before, they had that freeze on it because they had the debt ceiling debate. Now, you know, that's been put on the wayside because basically now they have an unlimited, they just have the ability to raise it without a vote. So we're talking about 212 plus, we're talking about roughly $700 billion. So, and tax money has come in, so that kind of skews it a little bit. But still, we're talking about a figure of $700 billion. Now, we know that the Fed is saying that they're continuing the taper, and the question is, where does this $700 billion come from? Now, we know that the 10-year note, this is the long-term chart of it, but if we pull up the 5-day, which kind of includes the Fed speak that's been going on, you can see that there was this brief spike in rates, and then it crashed, and then it's just kind of flattened out. So rates aren't doing anything to speak of. There's the year-to-date. They've gone down. They hit that 3%, down to nearly 2.5%. There's a 6-month and the year. So rates aren't doing anything to speak of, and the big question is why. So let's look at this Zero Hedge article. Is this the reason for the relentless Treasury bid? Over the weekend, Bloomberg had an interesting piece about two of the main reasons why, while stocks continue to rise to new all-time highs, the expected selling in bonds, because in a normal world, what is good for stocks should be bad for bonds, isn't materializing. And instead, earlier this morning, the 10-year tumbled to the lowest since February, while last week, the 30-year retraced 50% of its post-taper tantrum slide, or in short, a complete disconnect between stocks and bonds. Bloomberg's explanation was twofold. In a world awash with U.S. government bonds, buyers of the longest-term treasuries are facing a potential shortage of supply. Excluding those held by the Federal Reserve, Treasuries due in 10 years or more account for just 5% of the $12.1 trillion market for U.S. debt. New rules designed to plug shortfalls at pension funds may now triple their purchases of longer-dated treasuries, creating $300 billion in extra demand over the next 2 years that would equal almost half the $642 billion outstanding, Bank of Nova Scotia estimates. So the question here is, if pension funds are rolling out of stocks, and we did see a small correction in the stock market today, nothing substantial. In fact, let's pull up the stocks, and you can see that we're still in nosebleed territory as far as the stock market. Pulling out to the weekly, you can see. So the question is, if pension funds are rolling over their stock market gains and securing them in bonds to lock in an incredible 2.5% yield, which we know doesn't even keep up with real inflation, who is buying the stock market? That's the big question, because if they're no longer buying stocks and they're selling stocks, who is buying stocks? We know the public's not participating. So is it the banks, or is it in fact the Federal Reserve? So my thesis is that what's happening is, rather than purchasing the bonds directly via the quantitative easing, they're tapering off of that, and they're changing the rules to force the pension funds to buy the bonds, and then the Fed is coming in and buying the stocks that the pension funds are selling. Ultimately, since foreign buyers, excluding the strange Belgium $300 billion increase in U.S. Treasuries, which is ridiculous, excluding that, then we have all this pension money, and we're going to talk about that because that also is a big, gigantic Ponzi scheme scam. So let's look at this article from pando.com, leaked. Docs obtained by Pando show how a Wall Street giant is guaranteed huge fees from taxpayers on risky pension investments. So if you remember, traditionally pension funds were required to invest in the most secure asset. I would say in the current environment probably would have to be corporate bonds, certainly at the mispriced interest rates of treasuries. I don't see how anyone could see that, could consider that to be a safe investment. Of course, they're not allowed to downgrade those, because we know that when one of the rating agencies came out and downgraded U.S. debt, then they were hit with a indictment. So it's very dangerous to downgrade U.S. sovereign debt. But nevertheless, the pension funds are assuming rates of return around 8%, and the treasuries are yielding around 2.5%. That's on the longer term. That's the highest. So the question is, where are they putting the money to try to get that 8%? Well, the answer is it's being stolen by Wall Street. When you think of the term public pension fund, you probably imagine hyper-cautious investment strategies kept in check by no-nonsense fiduciary laws. But you probably shouldn't. An increasing number of those pension funds are being stealthily diverted into high-fee, high-risk alternative investments that deliver spectacular rewards for Wall Street firms paid to manage them, but not such great returns for pensioners and taxpayers. Citing data from the National Association of State Retirement Administrators, Al Jazeera America, isn't that crazy? We have to get our news from Al Jazeera and Russia Today, recently reported that the average portion of pension dollars devoted to real estate and alternative investments has more than tripled over the last 12 years, growing from 7% to around 22% today. with public pensions now reporting $3 trillion in total assets. That's up to $660 billion of public money in these high-fee, high-risk investments. And yet, despite the fact that they deal with the expenditure of taxpayer money, the agreements between public pension systems and alternative investment firms are almost entirely secret until now. Thanks to confidential documents exclusively obtained by Pando, we can now see some of the language and fee structures in the agreements between the alternative investment industry and major public pension funds. Taken together, the documents raise serious questions about whether government employees, trustees, and politicians overseeing major public pension funds are shirking their fiduciary responsibilities under the law when they are cementing alternative investment deals. The documents, which were involved in a recent SEC inquiry into the $14.5 billion Kentucky retirement system, were handed to us by SEC whistleblower Chris Taube, an investment consultant and former trustee of KRS. Taube has also written a book, Kentucky Fried Pensions, about the scandalous state of the Kentucky public pension system. The documents provided by Taube, embedded below, specifically detail Kentucky's dealings with Blackstone, a giant Wall Street investment firm which has deployed a platoon of registered lobbyists in Kentucky and whose employees are major financial backers of Kentucky U.S. Senator Mitch McConnell. The Blackstone-related documents, though, don't just tell a story about public pensions in Kentucky. The firm, which just reported record earnings, does business with states and localities across the country. The Wall Street Journal reports that about $37 of every $100 of Blackstone's $111 billion investment pool comes from state and local pension plans. In one set of documents provided by Taube, Blackstone's payment structure is outlined with the language guaranteeing that Blackstone will receive its hefty annual management fees from the taxpayer regardless of the fund's performance. In other documents, public pension money is exempted from some of the most basic protections usually guaranteed under federal law. Other contract language appears to license Blackstone to engage in financial conflicts of interest that could harm investors. Despite the documents involving government agencies and taxpayer money, they are all marked confidential. The public is not allowed to see them. Taube says the sheer size of Blackstone and its attendant ability to set industry standards means that the documents he obtained represent a story that goes way beyond one state. Quote, "These agreements aren't unique to Kentucky. They are everywhere," Taube told Pando. "They include exactly the kind of risk and boilerplate heads I win, tails you lose language that is almost certainly standard in the contracts that so many other pension funds have been signing. This is a national problem." Blackstone's fund of funds up $200 million a year in up to $200 million a year in fees and underperformance that can harm taxpayers. One of those documents given to Pando by Taube is a confidential memo to KRS Investment Committee members from August 2011. In the memo, KRS staff outlines their desire to invest roughly $400 million in Blackstone's Alternative Asset Management Fund, which is so-called Fund of Hedge Funds. As documented on page 7 of that memo, Blackstone was guaranteed whopping fees of 50 basis points plus 10% of any overall profits on retirees' money. In addition, the memo estimates 1.62% management fees and 19.78% incentive fees to be paid on top of the Blackstone fees to the underlying and undisclosed individual hedge fund managers in the fund of funds. Pension officials made the decision to invest in the fund despite Blackstone then reportedly being under SEC investigation. According to KRS's latest annual financial statement, Kentucky now has more than $500 million invested in BAM. In 2013, according to KRS data, BAM earned an 11.54% return for the pension system. That was 20% below the S&P 500 that year, meaning, Taube says, that Kentucky taxpayers would have earned $78 million more in an almost feeless S&P index fund. Those figures are consistent with a recent study from Maryland Public Policy Institute showing that state pension systems that pay the most for Wall Street money management get some of the worst investment returns. Fees, says Taube, are a driver of the underperformance. Using the secret memo's figures, Taube estimates that 33% of the stunning one-year underperformance, or about $25 million, was in the form of fees paid to Blackstone and other managers in its fund of funds. According to data from the investment research firm Preqin, 20 other public pension funds are also invested in BAM. Assuming those funds invested in BAM under roughly the same terms as Kentucky, Taube estimates that Blackstone and underlying managers in BAM raked in well over $200 million in fees in 2013 on just that one fund of funds. Absent from the memo to the trustees are any details about which particular hedge funds are in the BAM fund. In an interview with Pando, Taube argues that was by design because he says Kentucky officials wanted trustees to vote on the investment without being able to do due diligence. Taube says that meant trustees were not made aware that BAM invested in SAC Capital, the firm whose executives recently pled guilty to insider trading charges and who at the time of the Kentucky investment were already under SEC investigation. And it goes into it. You can read more of it. The American Federation of Teachers, of course. And of course, there is political influence. We know that this is basically bribery and payoffs. And then there's the connection to Mitch McConnell. Pando requested comment from Kentucky Retirement Systems 4 days before publication, but KRS did not respond. However, representatives of the alternative investment industry did. In response to the disclosures, Blackstone Senior Managing Director Peter Rose told Pando, "Our funds have produced equity-like returns with bond-like volatility over a market cycle and a protected capital in down equity markets. We are proud of what we have been able to achieve for our investors in over 2 decades of investing." Additionally, the Trade Association for the Private Equity Industry also responded to the disclosures, acknowledging that a majority of private equity investment comes from institutional investors such as public pensions. Noah Theron of the Private Equity Growth Capital Council told Pando, "Research has consistently shown that private equity is the best performing asset class for pensions over the long term, but as in the case with any investment, it is not without risk." And we find when we look at the disclaimers in the documents that they can lose part or all of the investment. So obviously that's not something that people's pensions should be invested in. So we can see with these stories, the games go on, the same things that they've always done. Wall Street is still doing. They're looting money from people's retirements. The Fed, on the other hand, is forcing retirements into the treasuries, which we know are going to be inflated away to nothing. And so, again, they're trying to steal everything that's not nailed down. They're not done yet because they're not done stealing everything. So, as long as people continue to trust the shysters on Wall Street and the criminals at the Federal Reserve with their money, then this is going to go on. There's still going to be money to steal. Eventually, it's going to end. Now, we know by the 1% rule that they're proposing that at some point they believe that the precious metals are going to respond, and ultimately people are going to realize that this is the only safe place to put your retirement. It is not safe to put your retirement in government bonds, and it is certainly not safe to put your retirement with hedge funds. And we'll talk to you next time.